All right. Dow Jones. For those familiar with Rwanda, it's the ticker US30 USD. That's a contract for different sticker that I use to trade the US Wall Street 30. And Stan likes the weight of evidence, and that's really sticks good to me since I've been doing weight of evidence, digging deeper. It's helped me not pull the trigger as fast, always trying to find reasons not to enter a trade. So yes, the price action is the final decision. So you have stage analysis, you have those triple confirmed breakouts, as in Stan's book, above the 30 average, above a horizontal breakout line, the volume, double the volume of the previous 4 weeks. But he has other chapters, and the first time you read the book, you just glance over them. He talks about a higher time frame to make sure you're aligned with that. It's something we have tendency to skip. That's why I'm always looking at the monthly chart before playing on the weekly. And he has a chapter on contrarian theory, showing news clippings from the 70s, 80s of when the Dow to the moon and all that stuff. And then actually that was the high. Then it went down from there, etc. And when it's the end of the world, then that's probably the bottom. And he looked at a whole bunch of other indicators. And I like, when I want to play the index, for stocks, he says to look at the industry it's in, its peers, if it's outperforming them, its sector, its index. Well, when you're playing the index, you're already pretty much at the top of the food chain. So you could compare your index, the Wall Street, to the other ones. But if you want to get additional information on the health, the weight of evidence for indexes or indices as a whole, if they're going to go up or down, then I found very useful to go to economic data. The Fed. What do you have here? St. Louis Fed Financial Stress Index. You'll see there, we're going to look at that, how that applies, how could that help us with the weight of evidence to know if this is simple correction that we're just going to go bounce back up, or we're at a point of no return where the next step is just, it needs to reset, it needs to crash hard, needs to do a 61% retrace or whatever. That's going to help us. But you're also going to combine that with payrolls, non-farm total payrolls. You'll see that this has been an indicator of stock market declines or inclines. You know, there's stuff like the market's looking for trade war resolution for it to go up. Yeah, okay, maybe, or maybe it's already priced in now, and when they're actually come with deal, it's going to sell. It's hard to grab that type of information, how much it impacts the graph on the chart. I've noticed, and we're going to see it, that non-farm payrolls, the market really, really likes that metric. Unemployment rate goes hand in hand pretty much with the total non-farm payroll employment. And then you got two other ones, two important pillars of economic data is the Fed's fund rate, the interest rate. See how it's been climbing. We're going to check out how that's going to impact the price action of the index that we want to play, and the monetary base. Both go hand in hand. So let's do it, guys. Let's see first what happened in 2008. Can we get some details right here? Oh, okay. 2008. Top formation. Broke down right here. The Dow. Still 12-month moving average flat, starting to turn around with all this price action below. Pulled back up to the 12-month moving average before doing the next leg down. And here you had a bigger top right here. So price action broke down, hit that monthly defined support, came back up. Great entry here to short, creating lower highs. 12-month average going down. You know the drill. Now you close below that monthly defined support, and off you go. Pull back close to 12-month average, and then eventually, market has energy. Bring back up once, some energy to bring it back another time. And after that, it's just too much, and the weight just sucks this thing all the way down. So how was the stress index behaving back then, 2008? Zoom, 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 zoom. Right here, we had a plateau. Let me contract that. Okay, that's a little bit better. Right here. So there's two zones. There was a nice base it had right here below at a 850 minus 0.15 below the zero line. And then it broke out above. As soon as it broke out above, the market started going sideways right about here. That was almost close to the top, going sideways. The index starting to hit some support, some resistance, never going back down to this low stress level. And finally, when it broke out above here, we're right here. The market had already started rolling over in this sector here, and then after that, it just stress index exploded after the fact. We're following right here. No, it broke out above right before we had that long leg down, guys. So the market was already rolling over. He had clues right here that it's going up. It's the stress index going up, and it's a matter of time before it goes crescendo and just goes kaboom, full meltdown. So then after that resets, what happened? So we're not quite here. I have a long base. And if I don't want to get greedy, one test, two tests. One, two. We're starting to break out of this lower base right here. Let me just crunch that for that. Right. Cool. So I have it right here at this, almost at the zero line. If we get it close, it's already etching upwards, guys. If we close above already this level right here, the minus 0.55, this might start accelerating and confirming that we're not going to overcome that top once again. It might also slow down this pullback that we have close to the 12-month moving average. All these clues might come in together at the same time. And if we close above that zero line, this could be the area where the price actually would have moved a little bit here. And then after that, we might have a meltdown at this level here. Cool. Okay, what about the unemployment, guys? Where's my price action? Okay. Unemployment. It already starts to roll over before it crashes. You see right here? 138,418. Right here, it's already starting to roll over. Right here. And we're already below the 12-month moving average. We're below that first breakdown. And after that, it keeps going down and down and down. Let me zoom that up. Whoa. Stretch. Wow, a lot of gymnastics, chart gymnastics. Already starting to roll down. Let me put a vertical line. Here's the first time that it started rolling down. And look right here. So the first time it rolls down, the price action doesn't shoot down, but we already had close below that top formation. Did not help that the non-farm total payroll started declining. The next month still declines, still declines, still declines. So we're declining way before we had that secondary pattern breaking down. So that's a clue. It hasn't always been like that. I looked back, but in 2008, the payroll was already starting to turn down before we had that final leg down, guys. And look how the payroll keeps going up and up and up. So does the stock market. So does the Dow. And right now, what I would like is next month or next time to have a payroll, I want to see that rolling over. I want a negative number. I want that number, that 150,263. I want that to be lower right here. I don't want it to keep going up. And that would help me. That's the type of weight of evidence I'm looking for, other than just the technical deconstruction or breaking down of that top formation. That combined with the stress index keeping going up, that would just add weight of evidence. Weight of evidence, technical breakdown, below 12-month moving average, all that classical stage analysis stuff. Now we add St. Louis financial stress index. If it goes up above these levels, we add the payrolls, total non-farm payrolls. If it starts declining, that's really something we want to look at, because we've seen in the past the market has looked at that. Unemployment rate, well, goes hand in hand. As you can see right here, the unemployment rate has already been going up. 460, 470 right here. Oh, 5, already starting going up before we're even close below the 12-month average. And it keeps going up and up. And after that, that doesn't help. So that's another metric we could start looking at. Right here, we're close to the bottom. There's not much room to go to the bottom. So are we going up? Oh, yeah, we're starting 370, 380, 370, 390. So it's already starting to go up. Embryonic. We're at this area right here. It could be 4 or 5 months just ahead of schedule. Right here we're about. And let's just see if that unemployment rate could keep going up and up. That'd be some more weight of evidence. That would be that would add on to the top of that. Okay, that super duper funds rate guy. The funds rate was super low, kept bringing up. Stock market still goes up. And it's only when they start cutting it. So it's flat. And when they start cutting it, the price action jumps a little bit. But after that, that's a sign that the economy, if they're lowering it, it's because there's a problem. Not because of the stock market. See, they're already starting to lower it before the stock market is giving any signs that it's going to do this. They're already lowering it in advance, guys. And then when they start lowering it, it's like, is there rallies? Sometimes there's rallies. This is a monthly candle chart, so the rallies can't be that important related to interest rates going up, guys, on the monthly chart. Flat, then keep going down. So that's what I want to see. I want to see a pause in the interest rate, and I want to see a decline. And the decline in interest rates is kind of the Fed confirming to us that, yeah, there's economic problems. They start declining it even before the unemployment rate here is starting to drop, guys. They were already starting to decline it. And the unemployment rate was just starting to creep up barely right here. And they already started declining the Fed's fund rate, guys. So that's what I want to start seeing here. I want to see the funds rate flattening and decreasing. And if that decreases, it's going to give me a sign, another weight of evidence that the underlying economic needs it and the Fed are doing it. So if the economics aren't there, the earnings, the guidance, whatever drives the market right here might not be there anymore, and we could be tumbling down. The base, monetary base, guys. We didn't have that issue back then in 2008. It was creeping slowly. But right now it's been going up. It's been propping the market up. And I think that's going to be an additive factor. It's going to pile on. It's already starting to, let me see, that. Already starting to go down. And that's going to be, I think, a compounding factor on not helping the stock market going back up, guys. So I'm going to keep looking at that. And I want to keep, the more I see that the funds rate keep going down, the more money is removed from the markets, the more less of a lifeline we have right here, and I expect the markets to follow that trend going down, guys. So that's it, man. That's economic data that I'm looking at now. I put a whole bunch of alerts at these levels. I have put an alert as soon as the payrolls, total non-farm payrolls goes down. I'm getting an alert. When the unemployment rate goes up, I'm getting an alert. And when all these add up, plus the price action of the chart tells me that I have a good risk to reward entry, that the price action has gone up close to the 12-month moving average, has gone up close to that monthly defined breakdown line. I'll know that I'll have a good low risk short entry, guys, and we won't be in a 2005, 2015. And that's a lot of times I look at 2015, I say, look, Pat, there's a close below that 12-month moving average. You could have gotten trapped. Well, we weren't quite here, guys. Look, the unemployment rate was still going down. We're still pretty high at 6, still going down. We weren't below this level right here on the monetary base. It was flat. Total non-farm payroll still going up. The stress index didn't even go above this level here, and we're still further away from that higher zero line. So you see in the weight of evidence, this wasn't a full meltdown potential right here. Not as much as we are today, guys. So this has given more weight to confirming that we're going to continue this downturn than remove evidence that, no, this is a 2015, 2016 episode, and we're going to go back up, and that this pullback will revert to a stage 2 continuation on the monthly chart. All right, guys, subscribe if you like this. Appreciate. Thanks.